Earlier during the Europe, Middle East, and Africa zone, we heard from 4 fintech innovators on the strategic decisions that their companies will have to make in order to prepare for 2021. Now, with the next session, we bring you the second episode on that same topic, moderated by Janos Barberis, co-founder of SuperCharger Ventures. We'll deep dive during a fireside chat with Maximilian Tayenthal, who is the co-founder and chief financial officer of mobile bank N26, to hear his thoughts as well. Now over to Janos and Maximilian as they continue their discussion around leading fintech companies and how they're planning to face challenges down the road.
Thank you very much, Glenn. It's a real pleasure for the introduction and everyone for joining us. Max, as we were talking before, the fact that we have 2 Austrian on a panel during the Singapore FinTech Festival, watched globally, is, if anything, quite fun. So, Max, I hope that next 25 minutes with you are going to be entertaining. And can you hear me well? All okay?
I can hear you well.
All right, fantastic. So we had those issues before, but now we're totally okay. So, Max, I have 4 different types of questions I wanted to ask you. Some about talent, other about product, market, and finally, the N26 finance and the vision of where you're driving the company. But, let's start. Building a company is taking people. You're one of the co-founders. How have your leadership changed between growing a company from 0 to 10 people, 100 to 500, and then going forward? Did you learn different tricks, and did it require different skills for you as a co-founder?
Yeah, absolutely. First of all, thanks for having me today. It's great to speak at conferences again. When we founded the company in 2013, we founded it out of our living rooms in a team of 2. And then we started to hire the first people. And very soon you realize that the story of building up a startup, like probably the story of building up any type of organization, is very much like a people's business. In the end, you realize, like in our case, you don't build a global financial institution, a team of 2 or a team of 3, but in the end, it's everything about the people, like to bring in the best talent, to retain them, to put the right tools in the hand, to engage them. And I think the big challenge has always been like getting the best talent on board globally. If you think about like the big steps of development, I think you could look at people, you can look at the organization, like how do you build a company, and you can also think about culture. If you think about the organization, it was first, we had this idea like disrupting financial services, building the first pan-European bank, then building a global institution. Then it was, first you have a vision, then it's about like launching your first product to the market, getting the first feedback of the customers, like super important when growing a company. First you have this idea, you build on something, and then really getting that live. The next big milestone was getting their own bank license, which was key for us to what we are doing. So we realized if we really want to like change the way how people do banking, we need to have the freedom of choice in terms of technology. And now we're moving in this highly regulated environment. And then, it was about internationalizing, like first being in Germany, then like getting to all the other European markets, and then like last year going to the US. And for that, it was always about like finding the people for that. And today we have 1,500 people. If you think about it, every 6 to 8 months in the last years, we were doubling the number of customers. And also every 6 to 8 months, we were doubling the size of the team. And that comes with tremendous challenges, like things that seem simple at first sight, like having the proper office space in place, but also about how to get people effective. Do people still do performance management? How do you onboard people? We realized people were getting onboarding from someone that joined us like 4 weeks before, who got an onboarding, who joined us like 6 weeks before. You also realize that in terms of alignment, things are changing. At the beginning, you are like 5 people. Everyone knows what we are working on, like launching a product, and then you have 20 people, and if you have 500 people, you realize, for example, having stand-ups is not working so well anymore. And it was always a challenge. It was always like we were bringing in the people, and then it was tremendous effort really also to build the culture around it, to build like the methods of alignment to actually get the people productive. And it was also like, I think a year ago, we actually stopped our growth, and then we said, okay, now we really have to make the people productive, have to align everyone behind the goal. So it was always like challenging. I think finding the right talent was key to the success and building a global team, and then basically like onboarding everyone on the protective, make them productive. If you think about N26 today, 1,500 people coming from 85 different nationalities, which is extremely interesting. And obviously you get a lot of different cultures, a lot of different perspectives, but it's obviously also like a challenge to get everyone on board. Also if these people are like working in different time zones and in so many different offices.
And so maybe if you pause here, which is, you're talking that people is key and, doubling your team size. Now COVID happens. You might have a team around the world that never met you. And, you're still very much a founder-driven company, right? So how is leadership being challenged when you cannot see your team? You said you started in a room with your co-founder, two of you who are knowing each other, talking to each other on a daily basis. And now you don't get to see your team exactly in the same way. So how has this really challenged your leadership of the company of having teams remotely and some of them never met each other yet?
Yeah, I think being an organization of digital natives, the average age of our team is below 30, and having them like dispersed in different offices in different countries. If you think about that, remote work, like working from different location, has always been part of our culture. But like most other organizations, probably we realized in COVID-19, working from home, it's perhaps more effective than we thought, but it's also more tiring than we thought. Things that you used to do like in just on the corridors, like talking to each other, now have to be scheduled in meetings. If you have big meetings, it also feels you're losing a lot of the context. You only hear the one person talking, but you don't see the other person like shaking their head. You don't see someone else also want to contribute something. So it is actually quite challenging. And in terms of developing a culture, 2020 for us, as probably for many others, was a very challenging year. We're thinking about also like loyalty to the company. If you think about someone who is not coming to the office for so many months and doing a certain job, and then, is getting like a call of a headhunter and say, you can do the same job, you do it for a different company, you earn 20% more. Like, obviously it's a big challenge to actually keep these people within the company. But I think if you think about many other industries like production companies, I think we in the digital space, we have been probably better equipped, and it was also much easier for us to adapt to the new world. If you think about
So you look at, so you have obviously behavioral change with your company and your team, right? But what about behavioral change on the customer side? So, people are now locked down, they're home. Being home means there's few shops you don't go to, your spending pattern can change, your rental can change. So did you also notice, using all the data you have on people, changing their behavior, and how is this affecting the product?
Yeah, probably every company around the globe was affected by COVID-19, right? Either positively or negatively. I think it's fair to assume that most of the companies or more companies were affected negatively. Like thinking back of, and really the first wave of COVID-19 was hitting Europe, and some of our markets were going into lockdown. There was a couple of immediate things that we were seeing. Like, one, activity of our customers in general was going down. Like, I don't want to complain. We also have friends like in the travel industries that have lost a significant portion of their revenues. It was definitely not like this, but if you think about during lockdown, how often did you go to restaurants? How often did you go to cinemas? How many travels did you book? How much fashion, like how often did you buy fashion, and so on and so on. I think that was one trend we were seeing. Also, probably short-term, less account openings. What we actually realized, and what we strongly believe it, that the trend to digitization was actually accelerated. by COVID-19. So more like we were always advocating cashless payment. If you think about like Germany, for example, is a very cash-heavy society. But in the streets, if you went to shops in Berlin, you used to see only cash-only signs in the shops, and now you have card-only signs suddenly. So there's a growing, and we also see this with our customers. The share of transactions in e-commerce has increased and continues to increase. The share of ATM transactions, the cash use has declined. And it's definitely like if in 2020, there was probably like less people in general that opened, especially during lockdown, that thought about opening a new account. But if you had opened a new account in 2020, you definitely wouldn't have gone, or you were less likely to go to a branch bank, but you would have used a more modern alternative and would have gone to a digital bank. So in generally, looking back at 2020, the impacts of COVID-19 have definitely been net positive, like in a way that they were accelerating a trend towards digitalization. And obviously N26 is a part of that trend.
So clearly positive for any digital business, right? So digital bank, digital selling. But one of the things that COVID-19 has also accelerated is unemployment. Unemployment means lower salary. Lower salary means, potentially default on loans. So, how is the N26 loan book? And when you look at what startups is all about customer centricity, being friendly, being, positive. But how can you even make, a customer-centric loan recovery process? Because it's down the line a very painful thing to fail on a repayment. It's a very painful thing to ask for that recovery process. So has N26 been impacted by this?
It was a deliberate decision that we are not operating a big loan book at N26. So if you look at our P&L, contrary to pretty much any other bank, our revenues are not really driven by interest income, but they're much more driven by commission income. And we are earning from payment of our customers. We have a subscription model of where we're earning. So we really don't have a lot of money at risk. So we definitely see there is more of the money of the customers is being saved. So we see also like an inflow in our balance sheet. And you mentioned customer service. Obviously, building trust with the customers is as important as always. Provide a good service, which is also a challenge in COVID-19 because obviously, if you think about customer service, people like working from home in some of our markets, it's definitely a challenge to really provide the best, the best user experience to our customers. But in generally, like our business is not driven by loan books, by a big loan book.
And talking of disruption, either positive or negative, depending on which side of the political spectrum someone is, N26 is going into the US, has gone into the US. Crazy year, election year, result announced. But now, let's not talk about US politics, but let's talk about the company. So, what has been the good thing about N26 in the US? Any bad news, any ugly learning of that market entry? It's a big stretch, right? It's a -6 hour time zone difference. It's not the pan-European challenger bank anymore. It's the US challenger bank now. So what have you learned from this, on the good side and on the bad side?
Yeah. First of all, internationalization is very much in our genes. If you think about the banking market in Europe and beyond, it's an extremely fragmented market. So in a way, you have French banks for French customers, you have German banks for German customers, you have Italian banks for Italian customers, and so on. And we today are the only ones that, based on one IT platform and one banking license, onboard customers all over Europe. And we realized after launching in Germany that the financial needs of the customers, probably throughout the whole Western world, they're very much alike. If you think about it, people want to have a place to store money, they want to pay, they want to save, they want to invest, they might want to have a credit, short-term, long-term, secured, unsecured, and you can think about FX and perhaps 2 or 3 other products, but that's basically it for the absolute majority of the customers. And we realized that a product that is a good value proposition for customers in Germany is also a strong proposition like in France. And we have the strong hypothesis that a product that's a strong customer proposition in Europe will also constitute a strong customer proposition in the US and in other markets. We launched in summer 2019 with a product that's substantially the same to what we have in Europe. And we could recently announce 500,000 customers in the US. I think 2020, in terms of challenges, there was definitely, I think growth was fine. There was definitely one big challenge. We couldn't travel, right? My co-founder and I and the entire executive team, none of us was like in the US since the beginning of the year. And in terms of, at one point in time, you also want to connect personally with the people, you want to engage, you want to interact. And that has been extremely challenging for us, like for other players on the market.
And you were talking about something which is French bank make money in France, German bank make money in Germany. But down the line, you have the same thing in technology companies like, Google, Amazon, Facebook. They make 80% of their revenue in their home market. And the internationalization piece is, it's a nice to have. It's a bit of an ego. It's a bit of a branding. But really, home market still dominates their revenue. Do you think that the US could generate 50 or more % of the company's revenue, or is it still going to be a very heavily European revenue driven? No, given that in Europe, the space is quite,
Definitely. If you think about it, 5 years ago, N26 was basically a German company. Today, say 60 or 70% of our revenue is coming from outside of Germany. I think in 3-4 years from now, 60-70% of our revenues can be coming from outside Europe. US is definitely an interesting case, and we only go into a market if we believe we can become the clear category leaders, which for us is the challenger banking space, or we want to be one of the top 2 or 3 companies. What is definitely true, it's different KPIs we're looking at. So if you think about Europe, 3 years ago, it was very much only about growth of customers, and then it's about top line growth. And at one point in time, also your investors expect you to have a proven business model that basically your customers can bear an increasing share of the cost, the variable cost and the fixed cost of the business. And today in Europe, all the customers are profitable, and every customer we're adding to the platform is generating a positive cash flow. We just believe in reinvesting that cash flow. We're not in the business to distribute dividends to our investors for the next years, but we reinvest all the money we earn from our customers, as well as all the money that we're going to raise in the future, and we are reinvesting it at positive return on investment into expansion, into expansion of the customer base, deeper in the markets and new markets, into the expansion of our products, more. We want to develop more features, and also into expansion of our team. If you look in the US, it's different KPIs. In the US, it's really about growing to a critical number of customers. We don't care about monetization yet. So it's really about investing into the market, getting to a critical scale, and then, expand there, and offering also then a broader product range. And by that also in the end, having a profitable customer base also there.
So you were mentioning a point which now goes, onto the finance side of the company. You said, in the US, we focus right now on acquiring the customer, being dominant. But now it's kind of the future of the company, which is, are you looking to stay a private unicorn in the next 1 year? Because the market has also shown, in terms of the IPO, the appetite of companies growing, customer base over revenue or profitability is decreasing. 2, 3, 4, 5 years ago, it worked. And right now, this is really being challenged. And WeWork was a little bit the party pooper on the thing, but I think for right reasons. So on your side, how do you see the company going? Is it going to be a private unicorn for the next, 1 to 2 years? Are you looking at the IPO market, or is there so much to be done and investor appetite for your US expansion that staying private allows you more control and allows you to keep on executing that vision?
Yeah, we're actually agnostic when it comes to fundraising, where we raise the capital. So for us, we have a very big vision. So we want to build a global financial institution. You can build a startup one or the other way. My co-founder and I, we have decided early in the days, we don't want to sell N26 for a couple of million euros to some bank, but we really want to build that global financial institution. And I think it's also the vision that most of the people working at N26 are clearly endorsing. And it's clear to make that vision become reality, you need a lot of funds. And I think what's important for us in the next year or two, we want to get IPO ready. So going public is definitely an option when it becomes the most efficient way to raise more capital. But right now, also, I think as you described it, I think the private markets are still like very liquid and very deep. And so we could definitely, the next round will definitely be still a private round. And afterwards, it could be a private round, or we could eventually decide to go IPO also. I think it's also an interesting signal. We are a B2C company, obviously having that kind of transparency. Also, we would love to have that. It's also generating even an additional layer of trust for our customers.
Okay, and so we have 5 minutes left. So last question, perhaps meant to be more controversial. At least in Europe and also in the US, a lot of the stimulus that the government has given has gone through incumbent banks, right? So you were an SME, you were an individual. If you were registered to a traditional bank, you'd be able to get 20, 50, or 100,000 euros or dollars of injection to your business. Most of that money excluded challenger banks. So my question to you is, it's a little bit of an unfair playing field, but who really benefits from this? Is the big four, the big, large multi-corporate banks? Who benefited from that policy measure? And do you think it was a nice way for the traditional banks to go, you see challenger banks, you might be growing rapidly, but when it comes to really supporting the economy, government look at us and they give a vote of confidence into us. So how did you perceive that of having challenger bank broadly excluded from being the channel of channeling money into the economy?
Yeah, I don't think, again, we don't have a big loan book. We're not providing like too much credit to our customers. So it's really something we don't care so much about. If you think about N26, we are about like to provide the best digital user experience to our customers. We also believe, we have funded with venture capital. If you think about it, venture capital is the most expensive capital quality on the market. Like if you think about, there might be some banks where the investors are happy, with 8% return on equity or like 10% return on equity. If you think about venture capital investors, and rightfully so, they expect, an 8x return on equity. So it also doesn't work so greatly to use venture capital as regulatory equity for building up a big loan book. So if you think about how we are monetizing, and if you think about our business model, this is really not dependent on credit. If you think about N26 business model and probably the ones of other challenger banks, you have to think about the cost base first. So one, we have like much lower overhead costs compared to traditional banks. We don't have a branch network. And if you think about our IT infrastructure, this is like, we have an IT infrastructure that's 2 years old instead of, 40 years old or more, as with some traditional banks. Like second, we acquire customers much cheaper than traditional banks. We're extremely passionate about our product. And every investment into that product is actually an investment in customer acquisition. So if you think about it, the majority of our customers are still coming to us through virality. Actually, they come to us because they have been exposed to the product by their friends. And that's why it is extremely important, like to have a high engagement of our customers, to have a good net promoter score, to actually have our customers advocating our product. And then also, we have, like, if you think about like our other cost blocks, like if you look at our offices, obviously look very much different than the ones of traditional banks. So one, we're operating at a very different cost base. And if you think about the revenue streams, it's really like 90% or more of these revenue streams are not coming from the traditional banking revenue channels. So this is definitely like not a topic we think a lot about. Plus, we talked about an IPO. If you think about a future equity story, we also don't want to be valued like a bank, and our balance sheet and our P&L shouldn't look like a bank. We don't want to sell at 50% book value of equity, but we want to really trade at a revenue multiple. So I think it's also, it doesn't make too much sense for us to build up a big loan book. If you think about it, building up origination power is something that's more interesting for us. So what we are actually developing a credit, like our like credit scoring to offer credit to more people. In the end, it won't end up on our balance sheet, but we will basically, syndicate it and hand it over to some other financial institution, because in the end, the customer doesn't care whether it's sitting on our own balance sheet or on the balance sheet of any other financial institution.
Okay, well, Max, perfectly on time. I do have to say, there's one thing that Austrian and German do well is staying perfectly on time. So we've been 25 minutes, Max. It's been a real pleasure. Thanks for joining again the Singapore FinTech Festival. For everyone joining us in the US, Europe, and also in Asia, thanks for tuning in on that session. And back to Glenn and the whole team at SFF for the remaining of today.
Thanks a lot for having me. Bye-bye.
And thanks to Janos and Max for that great engaging discussion. We've completed this two-part segment on a reset for 2020, trade-offs and strategic decisions.